A200. This is the BetaShares Australia 200 ETF. This ETF invests in the largest 200 companies by market cap on the ASX, and it's currently the lowest cost ETF. You're going to own companies like Commonwealth Bank, BHP, NAB, Westpac, Wesfarmers, and ANZ. So we're going to test out building a 3-fund 60-40 portfolio. All you need is a global equity fund, an Australian equity fund, and a bond fund. So we're going to use IOO, A200, and VAF. So VAF is always going to make up 40%, but what we're going to test out is a little bit of home country bias. How much should you put in Australia? Starting with $1 million portfolio and withdrawing $5,000 a month adjusted for inflation for the past 6 years, the portfolio with 10% in Australia grew to $1.3 million. The portfolio with 30% Australia, meaning half your money is in Australian equities, only grew to 1.18. So at this point you have to ask yourself, how much do I root for the home team? Maybe like 15% in Australia, maybe 25%. But diversifying your money globally has helped boost returns. Looking closer at the metrics of all the portfolios, it's interesting to note that the portfolio with 20% in Australia had the least amount of standard deviation. Having about a third of your equities in Australia seems to be a good recipe. We don't know if this is going to work in the future, but it has worked historically. A200 was made back in 2018. It has over $8.5 billion in assets under management, a great management fee at 0.04%. It currently has 200 holdings. This ETF has moved just like the market for the past 5 years with a 1.0 beta. The PE ratio is 20.96. The trailing 12-month yield is 3.09%, and you're going to get paid these distributions quarterly. The 1-year return is 12.37, 3 years 13.03, and the 5 year is 12.83%. The 3-year Sharpe ratio was 0.82, and the 5 year was 0.83, making this a great investment to put into your portfolio.